All right, joining us right now also from the Chicago Board Options Exchange is options trader and money manager Matt Shapiro, president of MWS Capital. And back with us from Tampa, warm Tampa, where I guess he's not dealing with any kind of snow, is Michael Yoshikami. Michael, by the way, president and chief investment strategist over at YCMNet Advisors, which has about $1 billion in assets under management. So, Matt, I'm going to kick it off with you because we've been watching volume, or should I say lack thereof. I mean, it's really, really low on the day. Not a surprise, or what?
Well, considering the past couple years, Carol, it is a big surprise. And actually, I think the quietness is really the big story, especially as we close out the year. Think about the last couple years. We've been conditioned to this high volatility that continued even through the holiday periods of the markets. And we just don't have it this time. And I think it's very bullish because those high frequency traders, the hedge funds, the dark pools, they can't push the market around. If they could, they would. I mean, how can you imagine the Dow is just down 10 points and just sitting there? So I think prices and values have crystallized. There's a bid in the market. It can't be pushed around. And I think that looks really good for 2011.
Michael, you think it's very bullish, too, for 2011?
Probably not for that reason, but I do think 2011 looks very, very good. I think there's tremendous liquidity in the market. QE2 is underway and in full swing. The tax stimulus that was passed, even though we're $1 trillion in debt, even more now, I think is going to be very positive for stocks. And I think corporate earnings are starting to bounce back. We still have a 10% unemployment rate, 9% unemployment rate in the United States, and companies are still operating. That means they're more efficient. And if they're more efficient, that means corporate profits. And when there's more corporate profits, what does that mean? It means higher stock prices.
All right. Speaking of stock prices, folks, we've just got a few seconds left in today's trading session. You're hearing the closing bell on this Monday, December 27, 2010. We're finishing near our highs of the session. But again, as we have been talking about, on very light volume. Call it flat there on the S&P 500, 1257. But we're still up. I think it's like 6 out of the last 7 trading sessions.
No, we were down on Thursday a little bit.
Yeah, but I mean 1, 2, 3, 4, 5, 6, 7. So we're up 6 out of the past 7 trading sessions on the S&P 500. The trend definitely for the month of December has been a higher one. Check out the Dow Jones Industrial Average. Call it flat there as well. Well, down just about 0.1% on a percentage basis, 11,555. And check out the Nasdaq, everybody. Again, really quiet trade here, up about 1.5 points at 2667. Now, Zahra's been tracking today's action, joining us now with a quick breakdown. But, you know, again, flat on the day, pretty much.
Flat on the day. But again, I think if you think about the China story, I mean, China raising interest rates, typically that has had a very negative impact on stocks. And you saw that much earlier on in the session. We did see some losses, especially when we look at the S&P 500 and the Dow. The Dow had been down something like 0.5%. So we did come back quite a bit. I mean, it was modest losses. And as you've been pointing out, pretty much light volume all day long. But materials and energy stocks at one point, they were among the worst performers. And of course, every time you talk about China, China impacts a lot of the commodities. In fact, if you look at oil down about 0.6%, that was part of the story there. But also, if you look at copper, an interesting development here, because you actually saw copper trade up, which is why, and actually trade near the record. So you actually saw materials come back from the red. They weren't as red as you can see right there. Pretty much flat on the day after trading as one of the worst performers earlier on.
You know, Michael, what do you think about the copper trade? Is that something you watch at all?
Yeah, we watch the copper trade very, very closely. However, there's something important to consider about copper, Carol. Copper is a storable metal, so I wouldn't get too excited if copper's being bought at low prices, like it was a year or so ago. That really is a restocking trade. It's less of an economic activity trade. So it is something we watch, but like all metals, like all commodities, you need to watch the consumable metals versus the metals that can actually degrade rather than the metals that need to be used right away. And so copper is a stored metal, but I think it's less an indicator of economic activity than maybe steel might be.
Well, Michael, what about this story that keeps going around about this one huge buyer in London that has accumulated something like 90% of the copper in store on the London Metals Exchange? What do you make of that? You know,
I'm not quite sure what to make of that. It does remind me a little bit of kind of the old silver hoarding story. So I'm not quite sure what to make of that exactly. But you know, in the end, it's as an investor, you have to keep that in mind, because you know, these institutional investors can push the prices around, and you have to be very, very careful when you have a large trader taking a position like that.
And Michael, to that point, Zahra here, to that point, I'm just wondering, going into next year, because we've seen materials and energy stocks really outperform in the last couple of months or so, and I'm wondering, going into next year, if China continues to tighten its economy, but the U.S. continues to expand its economy, can the commodities do as well as they did this year?
Well, I don't know if they can do as well as they did this year, but I think they can do well. And here's why, Zahra. I think that if you look at commodities, it really is becoming, in some ways, an alternative currency. Secondly, what you're starting to see in the commodities space is really a very, very clear, bullish, long-term linkage in emerging growth. And emerging growth, I think, is really going to drive the commodity space. Even though China is tightening, I think that what you're talking about here is basically capping inflation in China. You're still looking at rates of growth that we think are going to still be anywhere between 9 and 10%. And let's not forget also, Zahra, about the U.S. currency. While it's come back a little bit against the euro, it's still fundamentally, in our view, a flawed currency because of the level of deficit spending we have now. And if we have a currency that continues to drop in value, we're going to have money movement towards currency. So I think currency, oh, and then last thing, let's not forget inflation. If inflation comes back, that tends to be very good for commodities as well. So I think really commodities, it might not be a raging bullish argument, but I think it certainly is bullish, and I think it's bullish for years, not just for the next year.
Hey guys, I want to just kind of kick it forward a little bit to what we might expect over the next few days. I mean, it is kind of a holiday week here, you know, sandwiched between Christmas and New Year's. We do have some economic data points. Matt, how do you expect this to trade? Is it quiet all week, or are you going to see some increased volatility as we get closer to the end of the year?
You know, I think it's going to be tough to move this market. Look at the VIX at 1771. Had a little bit of a pop today, but that's really that three-day holiday weekend effect. And, you know, the market is just, I haven't seen it this stable and solid in a holiday period in 2 years. And I think that really looks good for 2011. And I think we're going to have to wait for the first quarter to see, you know, where these economic data points lay. You know, the big thing, as Mike pointed out, is that big, giant U.S. deficit and how that's going to impact the dollar. However, with interest rates moving higher on U.S. Treasuries, I think that shows that there's going to be a lot of bid for and essentially financial assets in the United States. And I think the commodities trade, while still positive, won't be as good as it was last year.
Matt, you're not nervous, though, by all this complacency? You talk about the VIX right now at 17. I mean, to me, it makes me a little bit nervous in the market because let's not forget, I mean, we've been talking all day about kind of the headwinds for 2011. Europe, potentially China as it reins things in. We talk about the municipal market here and states kind of getting their houses in order. The housing market's still a big drag and will be for years. Doesn't that continue to kind of take some of the luster off your 2011 outlook here?
Well, I think these are all concerns, but remember the concerns that we had over the past 2 years, whether or not exactly that the United States would actually be an ongoing enterprise. And look how strong the holiday season was and how strong all those retail stocks were this past year. So fundamentally, the American economy is showing to be a lot stronger than anticipated, despite the budget mess, despite the municipal concerns, despite Europe. So going forward, I really think if you look at the technical levels of the market in the S&P 500 and the Dow, given this low volatility and this quiet close for the year, I think it shows that we can have a really actually explosive rally in 2011. And I think the S&P 500 could actually go up 15 to 20% next year.
Wait, Michael, do you share that in kind of enthusiasm for next year, 15 to 20%?
No, I don't. Our number is a little bit less. It's 13%. So, but I still think if you think about it, compared to fixed income assets, compared to the interest that you're earning in money market accounts, 13% is a monumental difference compared to what you're going to get in more conservative assets. I think that the conservative asset right now that really is dragging investors down is the money market accounts. And when that cash starts getting off the sidelines, and still from an individual investor standpoint, Carol, it's not off the sidelines. Cash is still sitting in money market accounts.
Right.
When investors start to believe in that trade, you're going to see not only institutions, but individual investors go back into the market. At that point, I might add, that's when investors should start to become cautious, because that tends to be the last money to enter into the market.
Right.
And the reality is I think later on this year we are going to have to confront trillions of dollars of deficit spending and really gridlock.
You know, this is interesting. Joe Saluzzi is emailing, and I think he was on last week. I was out, but he said bullish consensus could be close to 100% now. These bulls paint a silver lining on everything, but they have the momentum behind them. You know, Adam, there are a lot of bulls on the market. You've actually found a bear who's actually bullish, though, on a few movers
on a couple,
still.
Well, and it's Larry McMullen who literally wrote the book on options. He's not that keen on the market right now. He says it's overbought short term, but he does find 6 names that he actually really likes a lot. And by a lot, well, he says you got to buy them, and he's long options, he's long call spreads, he's long the names, et cetera. There are a bunch of different strategies. Let me give you 2 of them. There's 6 or 7 total. Here are 2. The first is Chart Industries. GTLS is the ticker there. All right, look at this thing. These guys are in industrial gases, up 100% year to date. Another one, Riverbed Technologies. This one's up 200% year to date. These are wide area networks, Carol. So I guess the question, guys, and Michael, let me bring you in here. There are a lot of names that just keep moving up. I mean, can you keep buying some of these momentum names? I mean, do you agree with Larry on some of these names?
Well, I don't know about the individual names, but I do agree that momentum is very, very positive right now. You know, really, we have a divergence, and this is really an important consideration, a divergence between economies and markets. Our clients are asking this question all the time. How can the economy be so on an underlying basis troubled and the markets still move up? It moves up based on momentum and sentiment. Should the market go up 13% next year, like we're saying? We probably shouldn't if you look at the underlying fundamentals. But the reality is the money is there, the money movement is there, and I think you have to take advantage of that opportunity as long as you understand that at any moment the bottom could fall out of this. And so you have to be very, very careful as you invest, and in our view, be fairly conservative when you start taking these risks.
But let's not forget that corporate balance sheets are the healthiest they've ever been in a long time. And what corporations have
1.3 trillion in cash just for the S&P 500.
I mean, that's a nice little cushion. You know, Matt, any closing thoughts? Or we just got a few seconds here.
Well, I think Mike really hit it on the head. It's that sentiment shift that we've had in the first time in 2 years, and the markets can actually pull this economy up to where we don't believe it should be.
All right. I got to run, guys. Michael, Matt, thank you so much.